since the start of this calendar year 2016, we've seen a very material outperformance of the resources sector in Australia. It's outperformed industrials by 50%, which is a big number. That's been driven by two key factors. The resource valuations were very depressed at the start of this year, and then China embarked upon a major fixed asset stimulus program, again fueled by debt, which wasn't expected. The expectation was that they would be rebalancing their economy more towards consumption. So that was the genesis of the rally in the resources sector. It's been further amplified by the recent Trump win and his statements about fiscal stimulus in the United States. So we've got a very, very strong performance from the resources sector, but we think caution is a little bit warranted. A couple of reasons. We look at the Chinese economy. It's an $11 trillion economy. They spend $6 trillion on fixed asset investment, more than half their GDP. This is an enormous number, and it's been this number for many, many years, 15 years almost. So they've built out their economy to a point where there's overcapacity across the board, in toll roads, in bridges, in real estate, residential and commercial, in ports, and they've also built out overcapacity in major industry groups such as paper and packaging, cement, steel production. This overcapacity isn't a problem in of itself, but the problem is it's been fueled by debt. So we've got this situation in China where there's overcapacity and they're spending more than $6 trillion on fixed asset investment, and it's starting to decline in terms of growth. So let's compare this to the US fixed asset investment program. Trump's talking about $100 billion a year. Put that next to the Chinese fixed asset investment program of 6 or 7 trillion, you can see how immaterial the US growth is going to be. So we don't think you should be looking towards the US for commodity price moves. It should be what's going on within China. Our concern around the Chinese economy is that it needs to rebalance, and there is a major debt problem there. So fixed asset investment is declining. It's still growing at 4 or 5% per annum, but is likely to go negative over the next 12 months, and that's going to be very negative for commodities. China still consumes up to 50% of all major commodity groups, with zinc, aluminium, coal, steel. The only one they don't is oil, where they're more like 10%. So you can imagine if China's fixed asset investment program goes into negative territory, we're going to see a big fall in commodity prices. Now, to put the performance of commodities into some sort of context, iron ore's more than doubled to nearly US $90 per tonne. Now, the reality is we've spoken to a lot of traders and a lot of analysts in the iron ore sector. None can explain the move. And what they bring it down to is rampant speculation by Chinese traders to push that price up to $90. At $90, there's another 200 million tonnes of iron ore that can come onto the market, more than 20% of the seaborne market. That's not happening, so it's clear the companies don't believe the iron ore price rise. So we'd be very, very sceptical about joining the commodities rally and the resources rally. To be very careful, in particular the iron ore sector. We think it's unsustainable.